What is a ledger account and how does it work?
A ledger account is a record of all transactions that involve a particular asset, liability, equity, revenue, or expense. In simple terms, it is a bookkeeping tool that helps businesses keep track of their financial activities.
What are the components of a ledger account?
A ledger account typically consists of 4 components. 1. Title: the name of the asset, liability, equity, revenue, or expense being recorded. 2. Date: the date of the transaction being recorded. 3. Debit: the amount of the transaction that increases the asset, expense, or draws on the liability or equity. 4. Credit: the amount of the transaction that decreases the asset, expense, or increases the liability or equity.
How does a ledger account work?
When a transaction occurs, it is recorded in the relevant ledger account. If the transaction involves an asset, the debit side of the ledger account is increased, while the credit side is decreased. On the other hand, if the transaction involves a liability or equity, the credit side of the ledger account is increased, while the debit side is decreased. For example, when a company purchases inventory, the inventory account is debited, and the accounts payable account is credited. This means that the company's assets increase, but its liabilities also increase. At the end of each accounting period, the balance of each ledger account is calculated by subtracting the total credits from the total debits. If the debit side is greater than the credit side, the account has a debit balance. If the credit side is greater than the debit side, the account has a credit balance.
Why is a ledger account important?
A ledger account is an essential tool for businesses because it helps them keep track of their financial activities. By recording transactions in ledger accounts, businesses can quickly determine their financial position and make informed decisions about their operations. Ledger accounts are also used to create financial statements, such as balance sheets and income statements, which provide a snapshot of a company's financial performance. In conclusion, a ledger account is a bookkeeping tool that records all transactions involving a particular asset, liability, equity, revenue, or expense. It consists of a title, date, debit, and credit components and helps businesses keep track of their financial activities. By using ledger accounts, businesses can quickly determine their financial position and make informed decisions about their operations.